Welcome to another episode of Help Me Buy Property Podcast. And our topic for today is how to become a friend of Taxman and how to use business structures to your advantage. Now, nothing in this world can be certain except deaths and taxes. And so that is exactly what we're going to talk about. Not death, but taxes. I'm going to introduce my co-host today. He's a very dear friend of mine, my tax director for IPG Investor Partner Group, tax director or the owner of TaxWisers as well. I have Suhail Merchant with me. Hello, Suhail. How are you today?
Hi, Moss. I'm good. Glad to be here. Glad to be part of this podcast today.
Yes. And so a lot of our clients basically speak to Suhail first before they come and talk to me because, of course, taxes are very, very important when it comes to property investing and any business decisions, right?
That's true. Yes. Lots of people come and discuss their tax strategies before they invest in properties. And especially they talk about negatively geared properties. And for example, one of my clients, they said that and their spouse, they're paying about 70K tax in a year. And they heard from other friends, their friends, that with the similar kind of income, they paid only 35K of taxes, their friends. So clearly in their mind, it is tax savings for them when it comes to the negatively geared properties. What do you think? It's not savings, in my opinion. It's just complete wrong, because what they are not looking at is they are not looking at the other side of the equation. They're just looking single sided equation. And what I call is it's a fool's theory. Their disposable income is less after losing about 3K a month in mortgage repayments. They're not looking at that side of the equation. They're just looking at how much tax they are saving, but they are losing some cash on the other side as well. There's a difference
100%.
between positively geared and positively cash flow properties. We can discuss a little bit more about it, but mainly they usually focus on depreciation side of the things, which helps them to get the negatively geared property. Okay.
That's very true.
Yeah. So tax
That's very true.
depreciation, lots of property advisor asks you to reduce your tax on, actually it's a temporary benefit. Yes, it gives you some benefit in short terms, the depreciation, but it's not actually. It is a trap. Okay, so I can give you an explain. I can give you further explanation regarding how it works. But yeah,
So let's take a pause there. And
yeah,
so I completely can relate to that. A lot of investors, when they come and talk to me as well, they've been talking to someone else, or a sales agent probably, who is
mm,
talking them about depreciation benefits, who is talking to them about how much money can you save on a year to date basis or annually, or the tax that you're going to get back. I was speaking to this person last week where he said, Moss, I'm going to get $40,000 back in the taxes. And he was so excited. And
yeah, that's true.
I was like, why are you excited? You should be crying because you've spent $90,000 to get $40,000 back. Like, how does that work? Like, so how about you give me $90,000 and I give you
That's
$40,000
true.
back?
That's true.
Would that work? And so I think it was such an eye opener for him when he thought about it in a simplistic term, that he has paid 90 to get 40 back.
That's true. I
And
mean,
so and so you think about positive cash flow and positively geared. Definitely, a lot of people are very confused about what is the bigger difference between positive cash flow and positively geared. I think what a lot of these salespeople are doing is focusing more on the positively geared side of the equation, because from a cash flow perspective, these properties would potentially be negative, but when you bring the gearing, or when you bring the tax side of things into the consideration, they become positive. Is that right? Is that what we are talking about here from a positive cash flow and positive gearing perspective?
yes, definitely. I mean, just for the sake of people to understand, cash flow positive is purely cash positive after tax versus positive give when the property is positive give, even before considering the tax flow or tax implications. The concept of positive gain property is also slightly expanded these days by considering limitations on loan. That is truly a positively gated property also those that do not limit your borrowing capacity. Okay, that's the people. Lots of clients are confused about these things. They don't understand the concepts behind how it works, basically the mechanics, especially in terms of borrowing capacity. So with changes in the new tax laws are coming through nowadays, positive cash flow are usually brand new, are for the brand new properties or brand new townhouses, or in the newer estates you buy property, usually have no growth associated to them, as its tax benefits associated are with fixtures and fittings that can only be claimed on brand new properties. Okay. With
Yeah,
the interest rate this low, the only reason one should aim non-positive cash flow property would be for development only, and development potential properties in a growth suburb would those kind of properties would seek higher potential exponential growth actually. So thus in order to
sure,
so in
sure.
order to answer your question, you would always get better value of money with in positively geared property in growth suburb. Even neutrally geared property with value add in growth suburb is better than just off the plan brand new stock. So yeah.
Sure. And let's expand on this a bit. So when we talk about depreciation benefits, of course, they are benefits that you get
Correct.
when you buy properties for, be it brand new or be it property where there is a lot of renovations done. How is depreciation benefit a temporary benefit? Talk to us a bit about what does deferred tax liability means. I understand that, but from the user's
Yeah.
perspective, what does that mean that it's a short-term benefit and not a long-term benefit?
Yeah. Okay. So let me explain. Say you bought a property for 500K, okay, and you claim about 10,000 depreciation a year. After 5 years, you have claimed about 50K in depreciation, and let's say saved about 25,000 in taxes. Okay, great, that's fine. But now when the clients they are ready to sell their property, let's assume there's no growth in that property at all, and when they're selling the property, they're getting the same price, 500K, and they sell the property at 500K, they actually made a gain of 50K because their houses cost actually 450K. And why? Because the cost base has gone for 450K because they claimed 50K already in depreciation. You have to reduce that amount from the cost base when you're selling the property. So basically, you're getting some benefit of some taxes in short term, okay? But eventually, you have to pay tax on that amount you already claimed previously. So it's kind of
Sure.
you're deferring your tax liability for future whenever you're going to sell the property. It goes on like for future years. How for how long you're gonna claim tax depreciation? You're gonna lose that in the cost base of the property. So
Sure.
I don't think people should fall in this kind of trap of the depreciation. It's definitely there are certain benefits of having negatively geared property, especially when
From a
interest rates are higher.
from a
But
cash flow management perspective,
cash flow management,
more so
it's not
than
gonna work
this.
for the.
But I think one of the core assumption that you're making here, though, is the assumption that the property value does not go up, right? So
Yeah,
you're buying a $500,000
correct.
property, you're claiming a depreciation of 50K, the value doesn't go up. And majority of the times where you're going to get rich high tax depreciation, it would be a brand new property in a brand new growth corridor
That's
where
true.
the growth is probably 8 to 10 years away. I
That's
was
true.
speaking to a really good real estate friend of mine yesterday, and he bought something in Point Cook in 2006 in Melbourne. And he said, "Hey, Point Cook hasn't done really well." And I was like thinking, huh, why does he say that? Like there is $1 billion properties selling in Point Cook, right? And so I asked him, when did you buy it in Point Cook? And he said, I bought something in Point Cook in 2006, a brand new schmick looking property in 2006 for $320,000 at that time. And so I said, how much is the value right now? And he said, about $800,000. And so he said, I've made 1.5 times. And I was like, yeah, but that's great, right?
Mm.
But then I reflected that he has spent close to about 15, 16 years, 17 years. And so if you
Yeah,
think about it, he was sold this idea of catching depreciation, catching benefits on depreciation. If he would have bought established property, probably in 2012 or 13, he would have made exactly the same amount of money.
that's
The
true.
property didn't go anywhere.
That's
There
right.
was no growth between 2006 all the way to 2013.
Yeah,
And so that depreciation benefit didn't do
much
him a lot
there.
of justice.
That's
Yeah.
right.
And so that definitely makes the point. And so this is great. I mean, we are talking about taxes. Let's talk about Taxman itself and the strategies that we would use to beat the Taxman on its own game. Now, I understand that have nothing against taxes. I know that
That's
you always say this, that we need to be
it's a necessary evil,
disciplined,
basically. You need that.
100%.
Yeah.
But then, you think about it. And hand to heart, I always say this, that this is like legalized robbery, right? The harder you work,
It's
the more
you have to pay.
pain it is.
Mm.
I read it somewhere that it says that income tax has created more criminals in the world than anything else in the world. And when I say criminals, I mean tax invasions, right?
Mm.
People do
All
tax
right.
evasion. So if you think about it, it's created more criminals in the world than anything else. And so what strategies can we adopt
Yeah. Look.
that can really help us to basically minimize the tax or play the game that the tax man is playing with us
Mm.
while still keeping them happy, but doing everything legally,
That's
nothing
right. I
wrong.
mean, everyone has to pay taxes, as you mentioned. Debt and taxes are definitely absolute things. You cannot avoid them, but you can manage them effectively. That's the thing. That you can't, I guess. But yeah, taxes, you can manage them with certain strategies you can employ. You need to speak to your accountant and discuss these sort of things. One of the strategy we usually discuss with our clients is the 6-year rule, for example. It's a main resident exemption rule to avoid paying capital gains, or to use the capital gains tax exemption on main residences. Okay, so how it works? When you have main residence, when you put your property you're living in, and you put that property on market as a rental property, and you don't have any other property as a main residence, you claim 6 years exemption when you sell that property. So how it works basically, you are moving interstate, for example, or you're renting somewhere else because of the work situation. You rent it out, your principal place of residence, earn income from that property, claim expenses for that property, and with before 6 years period is over, you move back in that property, and and you sell that property after that. There's no capital gains on that property, even though you earn some income from that property. So that's one of the strategy.
Awesome.
It cannot be applied for everyone, of course, but it is case by
Of
case
course.
scenario. So
Yes.
but you need to discuss with your clients. Some people, they don't even know, and they just say, even some accountants I have seen, they're claiming they are putting that property as a capital gains tax property because
Yes.
it earned some money there, but the client didn't have
100%
any other property in Australia as a main
at
residence.
that
So
time.
you can, yeah, there are certain other things in
100%.
detail you can do to manage that part. But yeah, it's one of the strategies you can use. Yeah. So
And so this is an interesting point.
yeah,
So of course, the idea behind this, the tax office, was that if you're relocating from one place to another place, you can use that strategy. But this strategy can be used predominantly for rent investors as well, where you can buy a
correct.
property, you can live in there, claim the principal place, move out, rent west. Especially when you're young, you are 23, 24-year old. You don't want a big debt, you don't want a big house. You can live in a shared accommodation with the friends, close to friends, etc. And so I still remember 2012, 13, when I did that strategy, and I was having that conversation with you,
Mm,
and we went out and spoke to a few different accountants. We thought, hey, is this really the right thing to do? Like, I remember having a conversation with one of my work colleagues at that time in 2012, and he was such a big person when it comes to investments. And I said to him, I'm renting my principal place of residence. And he asked me, huh?
mm.
How can you even do that? And I said, no, I'm 100% sure my tax accountant has told me this is an amazing set. So this is nothing new. This is
I think
something
you
that has
do.
been
That's
there
true.
for quite
Yes.
some time.
Yes.
It's just that people don't talk about it, and accountants don't even know about some of these strategies that sit in the background. And so 100%. What other things can we think about when we are talking about saving capital gains tax and, beating the tax man to its own game?
Yeah, when I was speaking to one of our clients, mutual clients, lots of people looking for properties to renovate, for example, okay, and they don't have any other principal place of residence. So it's renovators delight the capital gains exception as well. You can, if someone wants to, if they purchase a property, occupy that property and undertake renovation in that property, and then they'll sell that property only to move into another dwelling and repeat the process. They don't pay any capital gains, even though the property value has gone up because of the renovations. But you were living in that property at the time, or you can say that you were living in property. Then it qualifies for the main residence exemption as well at the same time, and you can keep repeating the same process. We know our clients that they have done that, right? So you know them as well. I know them as well. That they keep moving and jumping from one property to another, buy rundown properties, do some work, live while working on the property, and then move on to another one. So you can
Definitely.
avoid, or I should not use the word avoid, but yeah, you can uh, you can qualify for the main residence exemption there. So I mean, there's
Yes.
of course within the tax environment there are lots of strategy you can employ. Yeah, and the other thing, other clients, they have used different business structures to, for example, the family trust and discretionary trust.
And so trust is an interesting one, right?
Yeah.
So I always say this, that, death, taxes, and children, there is no convenient time for them. Okay. They're
That's
always coming in at inconvenient times. And so I think trust is one of the ways that you can navigate and tax plan it in a lot better. And so when we talk to a lot of people, especially going out there providing a bit of mentoring and coaching, a lot of people don't know how to successfully use trust. And so let's dive a bit more into this. you know uh,
yeah.
Trust was something that was predominantly used by sort of very wealthy people, and it was something that was not provided access to the common men. And so we can see that now on an ongoing basis, it's a vehicle that a lot of people are getting used to more, not just from an asset protection perspective, but also from a tax planning perspective. So let's dive a bit deeper into this as to how many types of trusts are there, and which is the trust that we should focus most on when we are talking about property.
Yes, sure. So, trust, in essence, trust is a legal vehicle through which a third party or it is trustee holds and directs assets on behalf of beneficiaries. Okay. The key elements of the trust arrangements are settler who creates the trust. Okay. Usually, in our situation, accountants create the trust, and the trustee who administer the trust, and the fund where the income is received, and the beneficiaries who benefits from that trust or income received from the assets. So one of the key features of many trusts is that there's separate ownership from the assets and the control, which can have both tax and asset protection implication, as you mentioned there. So basically, there are different kind of trusts. Predominantly, we use in a smaller scale business or a small investment or a small wealth creation vehicle. It's discretionary trust, which is usually a family trust, and families they combine their pool their money in a trust or the finances in a trust, buy property in the trust, and they have a discretion to use trust income. The property income is coming in the trust, and then when there's a time to distribute that income, they have a discretion and flexibility how they distribute that income to different beneficiaries. Okay, in a family environment, beneficiaries are husband and wife and kids. Kids under 18, you cannot distribute any income to under 18, for example. This is common in any trust anyway. You can, but yeah, there are higher tax implications. You have your parents, adult children, siblings, you can distribute some income. So it becomes a tax effective vehicle at the same time. And it keeps the asset within the family group as well, which is the protection at the same time. If there's any legal claim in your business or anything else you're working, for example, as an architect or doctors, usually they are very prone to legal claims. They employ these kind of strategies, especially trust structures, because it gives them that protection. You're safeguarding your family asset or wealth while you making profit safely. So that's the idea behind the trust. And discretionary trust is one of the very common trust people use to buy properties or invest in different investments,
Sure.
not just property maybe, but yeah, the other kind of
And so
trust. Yeah, sorry.
when you talk about discretionary trusts, I've seen people placing bucket companies within their discretionary trust as well, so that there are profits which you can't subsequently distribute to your family members, or they're
Mm,
hitting that threshold. You would see them holding that profits in those bucket companies to save more taxes in the future as well.
that's true.
Talk to us a bit about that as well.
Yeah, as the name implies, bucket company means you can keep bucketing your money in there. Yeah, so yeah, so
Perfect.
in the trust, like unlike you can retain profits in the company, but in the trust you cannot retain any profits. So by law, you have to distribute those profits to the beneficiaries every year and every 12 months. So sometimes you are not able to distribute, or you don't want to distribute certain income to a higher income earner, because both husband and wife, they are on a employment where they're earning high tax, they are on higher marginal tax rate. The income is high enough to pay lots of tax. So if you distribute some more income, they pay extra tax. Instead, you use additional company, which is called bucket company, where you can distribute that income to the company, where you pay 26% tax and keep it there for a while for future, you can take that money out slowly and recoup some taxes back later on. When the one of the family member has lower income for some reason, for family planning or other things, study, family planning, you have reduction in income, you can use that company to pay little bit income and recoup some taxes there. So yeah, it's again, it's not that you're not paying tax, you're paying little tax. Or when you don't have to pay
Sure.
more tax, then why would you pay more tax?
And can that bucket company further loan out that money to other projects or other companies or other trusts that you have in order to manage your books a lot better?
Yeah, it is possible to use that company as a different vehicle, as an investment vehicle as well. But yeah, you have to structure in a manner that yeah, you can utilize that money to invest further, or use that in a different scenarios. Yes, it is possible. Yes.
Sure. And so you have talked a lot about the pros of the trust, and what about the cons of these trusts, especially when it comes to property investing? What do you think would be the key cons of some of these trusts?
Yeah, I mean, that's a main thing usually where people think that it's very costly to establish or establish the trust and maintain them. Yes, it could be a little bit costly. Initial setup cost is around $1,500 to $2,000. That's one of cost. And then you have every year, you have to lodge your tax, and like you have to lodge your personal tax returns. So you have to do financials and things like that. So yes, one of the cons, you can say the costly, but I think benefits outweighs costs there. There are certain limitations what you can do with the property in under the trust. So there could be some disadvantages in that side, but usually they are not many limitations. When you go to the banks to borrow within the trust because you're buying property in the trust, you could be you need higher deposit sometimes. It depends how your mortgage broker is working with you. So sometimes it is you at least need 15% of deposit, or not 15, maybe 25%, 25% deposit for when you're buying the
Trust
property in the
lending.
trust and you're getting finance in the trust. Right?
Sure.
They are, I mean, certain people are worried about lots of paperwork as well. I mean, it's when you buy it in the trust, there are additional paperwork to be dealing with, you need to deal with, I guess. So sometimes there are longer settlements with the property, but these things, I think, they're part of the
Overall
strategy, I guess,
strategy.
overall strategy.
Of
So
course. 100%. Yeah. One of the key things that I've seen is that the losses getting trapped into the
yes, true.
trust,
I
which
was going
cannot
to
be
say that. Yeah,
distributed. Yeah, please
yeah. So I would say yeah,
explore a bit
yeah,
more on that.
that's the main thing, that previously the trusts were not so attractive for the investment because of the negative gearing, as we discussed initially. People were buying properties under their personal name because they could use the rental losses against their other income. In past 24 months or 2 3 years, when the interest rates are so low, it is not attractive anymore. So trust, usually when you have rental negatively geared property in a trust, you cannot use those losses against any other income. You cannot distribute those losses are quarantined in trust, and they can only be used, or can be used to offset future income. So that's the biggest on in my opinion. Other things you can manage, I guess. But yeah, if you are really looking for a negatively geared property and advantages of negative property, trust is not going to work for them. Okay, so yes, but it also helps in regards to the borrowing capacity as well. But I think we didn't talk about the borrowing capacity there, but trust
Yes.
can have their own borrowing capacity in future if you keep investing in the same trust, or especially positive cash flow property in your trust. Trust will have its own borrowing capacity, and you can safeguard your personal borrowing capacities for other things as well. So
100%.
that's yeah,
100%.
so there are certain benefits and certain limitations there, but it still can work for lots of people, lots of investors. Yeah.
And it's interesting. I hear brokers or people who are not an astute investor. You would hear them say this all the time, that buying a property in a trust reduces your borrowing capacity instead of increasing the borrowing capacity. And so the difference that I want to try and make here is that it might reduce the borrowing capacity at the start where you're going to buy
True.
because
That's
of that
right.
negative gearing. But from a long-term perspective, you would see that your borrowing capacity gets quarantined and you get more borrowing capacity because trust is almost treated as a separate person when it comes
That's
to
true.
bank looking at you and looking at the trust. And so you can set up a trust in such a sustainable manner that it can transfer over generations. It can move over years and years to come because it would be self-sustainable in nature. It's recouping its own debt. It's managing its own liabilities. It's managing its own repayments, etc. And one key thing that we forgot to talk about on the pro side is the land tax side of things. And so
Yeah, that's
I
true.
know
Yeah.
Queensland land tax was a big
Thing,
thing
that's
when
fine.
everyone was talking about it. And I remember making that comment out there that, because we are talking about trusts upfront, we always tell people to understand what the land tax implications are for some of these properties that you're going to acquire. And so it's an amazing vehicle to manage your land tax, isn't it?
That's true because there's different thresholds for personal property investment and the trust. When you buy property in a trust, there's a certain threshold. But if you have multiple trust, of course, yeah, the threshold get increased with the different because every trust will have their own threshold for the land tax purposes. But when you have multiple properties in your personal name, then all the assets in your name will be counted towards the calculation of land tax. So yeah, that gives
Yes.
you that was especially in the Queensland situation when they were looking into everybody's assets state who owns what, and then if you own any property in other estates, you would that would still be counted towards your land tax calculation in Queensland. Yeah, so that's definitely another advantage.
Yes. And so one thing that was definitely an eye opener for me when I learned about trusts was that when you are looking at discretionary trust or family trust, you can have multiple family trusts and multiple discretionary trusts. A lot of people think that, oh, you can have only one family trust because you have one family or
That's
one
true.
wife, right? But it's not related to one wife or one kid or one family. You can have 10 family trusts if
You
you
can't have
really
family.
wanted to,
That's
right?
true. That's true. There's no stopping
Yeah.
it.
And so that's some of these myths that we would really like to bust here. Now, we've talked a lot about discretionary trust. A very close brother or sister to discretionary trust is unit trusts. And talk to us a bit of a difference between a unit trust and a family trust, and where are unit trusts more important than discretionary trust?
Okay. Unit trust, yeah. So unit trust, it gives you some additional advantage like a company as well, but it still give you features of a trust. Okay. So unit trusts are usually used in a situation where you have other your friends who are not related to you or any you want to invest in a property where you want to pool in some money from other sources from within the friends and other family groups which are not part of your family trust, and you want to use their borrowing capacity as well to finance the projects you want to do. So most of the time we look at the unit trust when people are development they are in the development space, in property development space, because that gives you flexibility in terms of investment. The uh, certain you don't get the discretion of the distribution. It is dependent on how much you invest. You get the unit. It's like a shareholder. You get the unit holding in there, like shares. You get units in the unit trust, and it is tied up with your capital, how much your capital you invest in that particular trust. So it gives you both best of both worlds, like company and the trust. So it is not registered with ASIC as such, but it gives you that flexibility of a company's or benefit of that company side of things, and you can manage that with other people outside your family group. So they are very
Sure.
popular in development space, and people just buy property in unit trust, develop them, and then keep using the same vehicle if they're similar people, or they can add and remove people easily. With the family trust, you don't want to do that. You want to just keep a family asset in a family trust, and when you're doing development, it is better to have different kind of trust which can give you other benefits as well.
Yeah.
Yeah,
And when you talk about developments, I think a lot of people, what they tend to do is they tend to guide their developments through joint venture agreements.
that's true.
Whereas
Yeah.
trust is a perfect vehicle to basically embed your joint venture agreement into a trust so that, it's much more legalized, it's much more stamped, it's
Much more
legally
transparent. Yeah.
yes, correct. And so you can use that to your advantage. I think the best use is combining the two together when we talk about development world, right? So
Mm.
you have unit trust sitting there, which is your holding trust, which is buying the property in the first place, especially on the development side. But then you have discretionary trust, that is a unit holder to the unit trust. And now you are talking about a completely different vehicle, right? Where you can move properties through this, you can use deed of partitions. And so,
That's true.
again,
You can complicate as much. You can add layers of complication on top of it. Yeah, yeah, definitely. That's a thing. But with the basic one, unit trust is you can use unit trust for development with the JV agreements and deed of partition. There's a lot of other strategies you can employ in the development scenarios. Yeah.
yes. But the most important thing for this podcast is that, of course, a lot of these things, go out and speak and discuss this with your accountants.
That's true.
Go and seek financial advice if you want to. Go and seek a financial planner. This session is not for financial advice or tax advice or financial planning
You should
advice.
have done it in the
Of course.
first place. Huh? That disclaimer is important, though. Yes. Yes.
Yes, and so it's very, very important. And so that's the key, that the podcast is more about probing people in asking
Yeah.
these questions to their accountants. The podcast is not so much about taking the information from here and going and implementing it. Of course, we have Sohail here. If you are keen to come out and talk to us, please reach out to him directly, or please reach out to me or my team, and we'll be putting you in touch with Sohail. But thank you, Sohail. This was really, really informative today. Thank you for coming out. Any parting words for today?
No, no, no. Nothing is happening today. That's it. So thanks for discussing this topic, and hopefully our clients they're gonna learn something from here, and they'll definitely will take any questions if they need any if the queries are coming, just forward it to me, and then I'll answer those queries as well.
Perfect.
Okay.
Awesome. Thank you very much,
Thanks.
listeners. Thank you very much, audience. Keep smiling, stay safe, keep investing. This is Moss checking out. Adios.